Did you just see that tax refund land in your bank account? And are you already thinking of treating yourself to a brand new phone, weekend trip, or those designer shoes that keep popping up on your social media feed? I get it. But before you hit on that buy now button, let's chat about something that could be so much more valuable. Today, I want to show you how that refund can grow into something way more exciting than a quick thrill. Actual lasting wealth for your future self. I'm Toyin, and helping Canadians make smarter money moves is what I do every day. As a chartered professional accountant, financial planner, and money coach with an MBA, I've spent thousands of hours helping Canadians make better money and business decisions. Today, I'm sharing 3 powerful strategies that could completely transform how you think about your tax refund. I'm going to walk you through 3 straightforward, Canadian-friendly moves that can transform your tax refund into a real wealth-building tool. First, you're going to tackle high-interest debt and give yourself an immediate guaranteed return. 2, I'm going to show you how to double dip with RRSP contributions, creating a refund that generates more refunds. And thirdly, we're going to power up your TFSA Opportunity Fund, the tax-free foundation for whatever future you desire. By the time we're done, you're going to know how to put every dollar of your tax refund to work so that it is growing even while you sleep. Let me share a hypothetical example with you. Imagine Carlos, a young engineer from Calgary, Alberta. Last year, Carlos got a $2,400 tax refund and decided to celebrate by buying a brand new 75-inch TV. 6 months later, the excitement had completely worn off. His credit card balance was still sitting there, and the TV was now on sale for 20% less. Now, let's imagine a completely different scenario for Carlos this year. Instead, he pays his tax refund forward using the 3 ideas I'm about to share with you. The result? He eliminates $800 in credit card interest, sets himself up for a lower tax bill next year, and starts a TFSA investment that's on track to grow way beyond what the TV cost. Same refund amount, completely different financial future. Idea 1, tackle high interest debt. Why does this matter? Let's talk about credit card interest rate in Canada. We're often looking at rates above 20%. When you put your tax refund towards paying credit card debts, you're essentially giving yourself a guaranteed 20% return on your money. Not even the most successful investors in the world can promise you that kind of return. Think about it. Most investments can give you a return of 6 to 8% in a good year. So, this is a no-brainer first choice. How do you implement this strategy? First, grab a piece of paper or spreadsheet and list all your debts by interest rate from highest to lowest. Those credit cards are probably going to be right at the top. Then, take your refund and throw it at the highest interest balance first. Even if you only make a partial dent, you're knocking months off your payoff timeline and saving a ton in interest payments. Here's the part most people miss, and it's crucial. Once you've made that payment, set up an automatic extra payment equal to the minimum payment you just eliminated. This keeps your momentum going long after your refund is spent. Here is the benefit of this strategy to future you. Let's put some real numbers to this. If you put $2,000 towards a credit card that has a 22% interest rate, you're saving $440 in interest in a single year. That's money that stays in your pocket instead of going to the bank. To really bring this home, if you're carrying $5,000 in credit card debt at 22%, you're spending about $1,100 per year just on interest. Using your tax refund here is like getting an immediate risk-free 22% return. No investment advisor can match that guaranteed return. And it's tax-free. Idea 2, double dip with RRSP contributions. Here's where things get really interesting. When you put your refund into an RRSP, you get 2 amazing benefits. Your money grows tax sheltered and You create a fresh tax deduction that could boost next year's refund. It's a perfectly legitimate financial loop that works wonders for your long-term wealth. Here's how to do it. First step is to check your contribution room. Log into CRA My Account and look at your unused RRSP contribution limit. This ensures you stay within the rules. Then, deposit your tax refund as a lump sum. A lot of people wait until the RRSP deadline next February. But the best time to contribute is actually right when you get your refund. Here's a pro tip that most Canadians miss. File Form T1213 with your employer to adjust your tax withholding. This means less tax comes off each paycheck. You enjoy the benefits throughout the year instead of waiting another 12 months for your next refund. Here's the benefits to the future you. If you contribute $2,000 to your RRSP and you are in a 33% marginal tax bracket, you're looking at about $660 in tax savings next spring. That's money you can put right back into that same strategy, creating a positive financial cycle year after year. Here's a quick note for business owners. If you run your own business, this approach also works with individual pension plans and corporate RRSP matching programs. Chat with your accountant or feel free to reach out to me to explore these additional options. Idea 3. Power up your TFSA Opportunity Fund. The TFSA is one of the most versatile and powerful financial tools available to Canadians. It can be your emergency fund, your home down payment accelerator, or the seed money for your next business venture. And everything grows completely tax-free. Using your refund here gives you flexibility for your future goals without locking your money away as strictly as an RRSP would. Here's how to do it. First, check your TFSA contribution room on your CRA My Account. Many Canadians have tons of unused room because they haven't taken full advantage of this incredible account. Next, open a high-interest TFSA savings account or a low-cost brokerage account with a TFSA option. Then, divide your deposits strategically. Put 1/3 in a high-interest TFSA savings component for emergencies. Invest the rest in a diversified low-fee ETF. Here's the habit that makes all the difference. Set up automated contributions on each payday. Even if it's $25 or $50, the consistency of the habit matters more than the amount. Let's talk about the growth potential of this money you're putting away. With even a modest 6% annual return, a $2,000 initial deposit grows to about $6,500 over 20 years. And that's completely tax-free. Plus, if life throws you a curveball and you need to access some of that money, TFSA withdrawals are quick and penalty-free, unlike early RRSP withdrawals that can come with hefty tax consequences. Remember, despite its name, the TFSA is not just a savings account. It's a registered account where you can hold virtually any investments, GICs, stocks, ETFs, you name it. This flexibility, combined with tax-free growth, makes it an essential part of every Canadian's financial toolkit. So, here's your game plan for that tax refund. 1. Tackle expensive debt first. Free up your cash flow and give yourself that guaranteed high return. 2. Feed your RRSP. Create a positive tax-saving snowball effect year after year. 3. Power up your TFSA. Give your future self more options and flexibility. The real key is making that decision even before your tax refund hits your accounts. Have your plan ready and act on it right away before the money disappears into everyday spending. Want to dive deeper into making smart account choices? Check out my video, TFSA versus RRSP, which is better for your situation, where I break down when each account makes the most sense for your specific financial situation. See you in the next video.